Okay, reading dirty, non-current, or long-term liabilities. Learning outcomes. The candidate should be able to determine the initial recognition, initial measurements, and subsequent measurements of bonds, describe the effects, interest method, and calculate interest expense, amortization of bond discounts, premiums, and interest payments, explain the recognition of debt, describe the role of debt covenants in protecting creditors, describe the financial statement presentation and of a disclosure related to debt, explain motivations for leasing assets instead of purchasing them, distinguish between a finance lease and an operating lease from the perspectives of the leaser and a leasee, determine the initial recognition of initial measurements and subsequent measurement of finance leases, compare the disclosures related to financial and operating leases, compare the presentation and disclosure of defined contributions and defined benefit pension plans, calculate and interpret leverage and coverage ratios. Introduction. A non-current liability or non-term liability broadly represents a probable sacrifice of economic benefit to in periods generally greater than 1 year in the future. Common types of non-current liabilities reported in a company's financial statement include long-term debt, finance leases, pension liabilities, and deferred tax liabilities. This reading focuses on bond payments, and the leases, pension liabilities are also introduced. This reading organizes as follows. Section 2 describes and illustrates the accounting for long-term bonds, including the issuance of bonds, the recording of interest expense and interest payments, and amortization of any discount or premium, the derecognition of debt, and the disclosure of information about debt financing. In discussing the financial statement effects and analysis of the lease of these issues, we focus on solvency and the coverage ratio. Section 3 discusses leases, including benefits of leasing and accounting for leases by both leases and leasers. Section 4 provides an introduction of pension accounting and the resulting non-current liabilities. Section 5 discusses the use of leverage and coverage ratios in evaluating solvency. Section 6 concludes the summary and summarizes the reading. Practice problems in a CFA Institute format are included after the reading. Bonds payable. The section discusses accounting for bonds payable, a common form of long-term debt. In some contexts, the word bond is used for debt security with a maturity of 10 years or longer. Note refers to debt security with a maturity between 2 to 20 years, and the bill refers to a debt security with a maturity of less than 2 years. In this reading, we use the term bond and notes interchangeably because the accounting term treatment of bond payments and the long-term interchange and notes payables are similar. In the following section, we discuss bond issuance, initial market, and subsequent measures, repayment of bonds, including retirement and redemption, and other issues concerning the disclosures related to debt. We also discuss debt covenants. Accounting for bond issuance. Bonds are contracted promises made by companies or other borrowing entities to pay cash in the future to its lender, i.e. the bondholder, in exchange for receiving cash in the present. The terms of a bond contract are contained in a document called indenture. The cash or sales proceeds received by a company when it issues bonds is based on the value or price of the bonds at the time of issue. The price at the time of issue is determined as the present value of the future cash payment promised by the company in the bond agreement. Ordinarily, bonds contain promises of two types of future cash payments: the face value of the bond, and 2, the periodic interest payments. The face value of the bond is the amount of the cash payable by the company in the bond holders when the bonds mature. The face value is also referred to as the principal per value, stated value, or maturity level. The date of maturity of the bonds is stated in the bond contract and typically is a number of years in the future. Periodic interest payments are made based on the interest rate promised in the bond contract applied to the bond's face value. The interest rate promised in the contract, which is the rate used to calculate the periodic interest payment, is referred to as the coupon rate, nominal rate, and the stated rate. Similarly, the periodic interest payment is referred to as the coupon payment, or simply the coupon for fixed rate bonds. The coupon rate remains unchanged throughout the life of the bonds. The frequency with which interest payments are made is also stated in a bond contract. For example, bonds paying interest semi-annually will make 2 interest payments per year. The future cash payments are discounted to the present to arrive at the market value of the bond. The market rate of interest is the rate determined by purchases of the bond given to the risk associated with future cash payments, obligations of the particular bond issuance. The market rate of interest at the time of issue often differs from the coupon rate because of interest rate and fluctuations that occur between the time of issuer establishes the coupon rate and the day the bonds are actually available to investors. If the market rate of interest when the bond are issued equals the coupon rate, the market price or value of the bond will equal the face value of the bond, thus ignoring issuance cost. The issuing company will receive sales proceeds or cash equal to the face value of the bond. When a bond is issued at a price equal to its face value, the bond is said to have been issued at par. If a coupon rate when the bond is issued is higher than the market rate, then the market value of the bonds and thus the amount of cash the company receives will be higher than the face value of the bond. In other words, the bond will sell at a premium to face value because they are offering an attractive coupon rate compared to the current market rates. If a coupon rate is lower than the market rates, the market value of the sales proceeds for the bonds will be less than the face value of the bonds. The bond will sell at a discount to face value. The market rate of the time issuance of the effective interest rate or borrowing rate that the company incurs on debt. The effective interest rate is the discount rate that equals the present issuing company interest expense reported for the bond in the financial statements is based on the effective interest rate. On the issuing company's statement of cash flows, the company receives or sales proceeds from issuing bonds is reported as financing cash inflow. On the issuing company's balance sheet at the time of issue, bonds payments normally are measured and reported at the sales proceeds. In other words, the bonds payable are initially reported at the face value of the bonds minus any discounts or plus any premiums. Using a 3-step approach, the following 2 examples illustrates accounting for bonds issued at face value and then accounting for bonds issued at a discount to face value. Accounting for bonds issued at a premium involves steps similar to the steps followed in an example below. For simplicity, these examples assume a flat interest rate yield curve. More precise bonds valuations are interest rate applications in each time period in which a payable interest or principal occurs. The price of bonds is often expressed as a percentage of face value. For example, the price of bond issued at par, for example, in example 1, is 100. In example 2, which bonds are issued as a discount, the price is 95.79 of its face value. In example 2, the bond were issued at a discount to face value because the bond's coupon rate of 5% was less than the market rate. Bonds are issued at a premium to face value when the bond's coupon rate exceeds the market rate. Bonds issued with a coupon rate of 0 are always issued at a discount to face value. The value of 0 coupon bonds is based on the present value of the principal payment only because they are no periodic interest payments. Such issuance costs as printing, legal fees, commissions, and other types of charges are costs incurred when bonds are issued under IFRS. All debt issuance costs included in the measurement of liability bond payments under U.S. GAAP. Companies generally use to show these debt issuance costs as an asset, which was amortized on a straight line basis to the relevant expense over the life of the bond. Under U.S. GAAP, the debt issuance costs are deducted debt issuance costs for lines of credit as an asset because the SEC indicated that it would not object to this treatment under IFRS and U.S. GAAP. Cash outflows related to bond issuance costs are included in the financing section of the statement of cash flows, usually netted against bond proceeds. Accounting for bond amortization, interest expense, and interest payments. In the section we discuss accounting and reporting for bonds after they are issued. Most companies maintain the historical cost of bonds after issuance. They are amortized any discounts or premiums over the life of the bond. The amount reported on the balance sheet for bonds is thus the historical cost plus or minus the cumulative amortization, which is referred to as the amortized cost. Companies also have the option to report the bonds at the current fair value. The rationale for reporting the bonds as amortized historical cost is the company's intention to retain the debt until it matures. Therefore, changes in underlying economic value of the debt are not relevant to the issuing of companies' perspectives. From an investor's perspective, however, analysis of a company's underlying economic liabilities and solvency is more difficult when debt is reported at amortized historical cost. The rest of this section illustrates accounting and reporting of bonds of amortized historical cost. Section 2.3 discusses the alternative of reporting bonds at fair value. Companies initially report bonds as a liability on their balance sheet at the amount of the sales proceeds net of the insurance under both IFRS and US GAAP, ignoring any bond insurance cost. The amount at which bonds are reported on a company's balance sheet is referred to as the carrying amount, the carrying value, or the book value, or net book value. If the bonds are issued at par, the initial carrying amount will be identical to the face value, and usually the carrying amount will not change over the life of the bond. For bonds issued at face value, the amount of periodic interest expense will be the same as the amount of periodic interest payment to bond holders. If, however, the market rate differs from the bond's coupon rate at issuance such that the bonds are issued at a premium or discount, the premium or discount is amortized systematically over the life of the bonds as a component of the interest expense. For bonds issued at a premium to face value, the carrying amount of the bonds is initially greater than the face value. As the premium is amortized, the carrying amount of the bonds will decrease to the face value. The reported interest expense will be less than the coupon payment. For bonds issued at a discount to face value, the carrying amount of the bonds is initially less than the face value, and the discount or amortized carrying amount of the bond will increase to the face value. The reported interest expense will be higher than the coupon payment. The accounting treatment for bonds issued at a discount reflects the fact that the company essentially paid some of its borrowing costs at issuance by selling its bonds at a discount rather than being at an actual cash transfer in the future. This payment was made in the form of accepting less than the face value of the bonds. At the date of issuance, the remaining borrowing cost occurs as a cash interest payment to investors each period. The total interest expense reflects both components of the borrowing cost and periodic interest payment plus the amortization of discounts. The accounting treatment of bonds issued at a premium reflects the fact that the company essentially received a reduction on its borrowing costs at issuance by selling its bonds at a premium rather than there being an actual reduced cash transfer in the future. This reduction was made in the form of receiving more than face value for the bonds at a discount issuance. The total interest expense reflects both components of the medium cost or the borrowing cost. The periodic interest payment less than amortization of the premium. When the bonds mature, the carrying amount will be equal to the face value regardless of whether the bonds were issued at face value, a discount, or premium. The two methods of amortization of premiums are as follows. Okay. The accounting and reporting of zero coupon bonds is similar to the example above, except that no interest payments are made. Thus, the amount of interest expense each year is the same as the amount of discounted amortization for the year. The reporting of interest payments on the statement of cash flow can differ under IFRS and US GAAP. Under IFRS, interest payments on bonds can be included as an outflow in either the operating section or the financing section of the statement of cash flow. US GAAP requires interest payments on bonds to be included as an operating cash flow. Typically, cash interest paid is not shown directly on the statements of cash flow, but companies are required to disclose interest paid separately. Amortization of a discount is a non-cash item and thus apart from its effects on taxable income, has no effect on cash flow. In this section of the statement of cash flows that reconciles net income and operating cash flows, amortization of a discount premium is added back to net income. current market rates and fair value operating options. Reporting bonds or amortized historical costs reflects the market rate at the time the bonds were issued. As market interest rates change, the bond's carrying amount diverges from the bond's fair market value. When market interest rates decline, a fair value of a bond with a fixed coupon rate increases. As a result, a company's economic liability may be higher than its reported debt based on amortized historical costs. Conversely, when market interest rates increase, the fair value of bonds with a fixed coupon rate decreases, and the company's economic liability may be lower than the reported debt. Using financial statements amount based on amortized costs may undermine a company's debt to total capital ratio and similar leverage ratios. Companies recently have been given the option to report financial liabilities at fair values. Financial liabilities reported at fair value are designed as financial liabilities. A company selecting the fair value option for liability with a fixed coupon rate will report gains or losses when the market interest rate increases or decreases. When market interest rates increases or other factors cause the fair value of a company's bonds to decline, the company reports a decrease in the fair value of its liability and the corresponding gains. When interest rate decreases or other factors cause the fair value of a company's bonds to increase, the company reports an increase in the fair value of its liabilities and corresponding loss. The gains or losses resulting from changes in fair values are recognized in profit or loss. Few companies have selected the option to report financial liabilities at fair value. Those that have are primarily companies in the financial sector. Reporting standards for financial instruments and derivatives already requires these companies to report a significant portion of the asset at fair value. Measuring financial liabilities at other than fair value when assets are measured at fair value results in earning volatility. The volatility is the result of using different bases of measurement for financial assets as liabilities. Goldman Sachs elected to account for some of financial liabilities at fair value under the fair value option in fiscal year 2008. Goldman explains this choice, so that's, you don't really have to know that. It's just nice to know. Recognition of debt on bonds. Once bonds are issued, a company may leave the bond outstanding until maturity or redeem the bond before maturity, either by calling the bonds or purchasing the bonds in the open market. If the bonds remain outstanding until the maturity date, the company pays bondholders the face value of the bond at maturity. The discount or premium on the bonds would be fully amortized or at maturity. The carrying amount will equal the face value. Upon repayment, bonds payables is reduced by the carrying amount at maturity of the bonds, and cash is reduced by the equal amount. Repayment of bonds appears in a statement of cash flows as a financing cash outflow. If a company decides to redeem bonds by maturity and thus extinguish the liability early, bonds payable is reduced by the carrying amount of the redeemed bonds. The differences between the cash required to redeem the bonds and the carrying amount of the bonds is the gain or loss on the extinguishment of debt. Under IFRS, debt issuance costs are included in the measurement of liability and are thus part of its carrying amount. Under US GAAP, debt issuance costs are accounted for separately from bond payments and are amortized over the life of the bond. And unamortized debt issuance costs must be written off at the time of redemption and included in the gain or loss on debt extinguishments. For you have to see an example. A gain or loss in the extinguishment of debt is disclosed on an income statement, a separate line. Then, when the amount is material, a company typically discloses further detail about the extinguishment in the management decisions and analysis and or notes of the financial statements. In addition, in a statement of cash flow prepared using the indirect method, net income is adjusted to remain any gains or loss on the extinguishment of debt from operating cash flows, and the cash paid to redeem the bonds is classified as cash used for financing activities. To illustrate the financial statement impact of the extinguishment of debt, consider the notes payable purchased by B plus H or B and H Ocean Charters, example 6 below. Debt covenants. Borrowing agreements often include restrictions called covenants that protect creditors by restricting activities of the borrower. Debt covenants benefit borrowers to the extent that they lower the risk to the creditor and thus reduce the cost of borrowing. Affirmative covenant restricts the borrower's activity by requiring certain actions. For instance, covenants may require the borrower maintain certain ratios above the specific amount of perform regular maintenance on real estate used as collateral. Negative covenants require the borrowers not to take certain action. Covenants may restrict the buyer's ability to invest, pay dividends, or make other operating and strategic decisions that may adversely affect the company's ability to pay interest and principal. Common covenants include limitations on how borrowed money can be used, maintenance of collateral pledges as a security of any, restrictions on the future borrowings, requirements that limit dividends, and requirements that meet specific working capital requirements. Covenants may also specify minimum acceptable level of financial ratios such as debt to equity, current, and interest coverage. When a company violates a debt covenant, it is a breach of contract. Depending on the severity of the breach and terms of the contract, lenders may choose to waive the covenant, be entitled to penalty payments or higher interest rates, renegotiate or call for payments of the debt. Bond contracts typically require that the decision to be called for immediate repayments be made on behalf of the bondholders. By holders of the minimum percentage of the principal amount of the bond issue. Example 7 illustrates common disclosures related to debt covenants included in financial statements closures. Presentation and disclosure of long-term debt. The non-current or long-term liabilities section of the balance sheet usually includes a single line item of the total amount of a company's long-term debt due after 1 year, with the portion of long-term debt due in the next 12 months as shown as a current liability. Notes to the financial statement provides more information on the types of and natures of a company's debt. These notes discloses can be used to determine the amount and timing of future cash outflows. The notes generally includes stated and effective interest rates, maturity dates, restrictions imposed by creditors or covenants, and collateral pledges, if any. The amount of scheduled debt repayments for the next 5 years also is shown in the notes. Example 8 contains an expert from Johnson & Johnson 2008 filing and illustrating common long-term debt disclosures. In this reading, we focus on accounting for the simple debt contracts. Debt contracts can take on additional features, which leads to more complexity. For instance, convertible debt and debt with warrants are more complex instruments that have both their debt and equity features. Convertible debt gives the debt holder the option to exchange the debt for equity. Bonds issued with warrants give holders the right to purchase shares of the issuer's common stock at a specific price. Similar to stock options, issuance of bonds with warrants is more common by non-U.S. companies. Example 9 provides an example of financial statement disclosures of bonds with warrants issued by a Chinese company. Leases. A company wishes to obtain a company which wishes to obtain the use of an asset can either purchase the asset or lease the asset. Section 3.1 describes some advantages of leasing from the viewpoint of the leasee. Section 3.2 describes the classification of leases. Section 3.2.1 describes the accounting treatment of different types of leases from the perspective of the leasee. Section 3.2.2 discusses leases from the perspective of the leaser, the one who owns the asset. Advantages of leasing. A lease is a contract between the owner of an asset, the leaser, and the other party seeking to use the asset, the leasee. Through the lease, the leaser grants the right to use the asset to the leasee. The right to use the asset can be for a long period, such as 20 years, or a much shorter period, such as a month. In exchange for the right to use the asset, the leasee makes periodic lease payments to the leaser. A lease then is a form of financing to the leasee provided by the leaser that enables the leasee to obtain the use of the leased asset. There are several advantages to leasing an asset compared to purchasing it. Leasing can provide less costly financing. They usually require little, if any, down payment, and often are at lower fixed interest rates than those incurred if the asset was purchased. This financing advantage is the result of the leaser having advantages over the lessee and or another lender. The leaser may be a better position to take advantage of tax benefits of ownership, such as depreciation and interest. The leaser may be better able to value the risk associated with ownership, such as obsolescence, residual value, and deposition of assets. The leaser may enjoy economics of scale for servicing assets. As a result of these advantages, the leaser may offer attractive lease terms, and leasing an asset may be less costly for the lessee than owning an asset. Further, the negotiated lease contract may contain less restrictive positions than other forms of borrowing. Companies have also used certain types of leases because of perceived financial reporting and tax advantages. Although they provide a form of financing, certain types of leases are not shown as debt on a balance sheet. The items leased under these operation leases have not appeared as assets on the balance sheet. Therefore, no interest expenses or depreciation expenses included in the tax or in the income statement. In addition, in some countries, including the United States, because financial reporting rules differ from tax regulations, a company may own an asset for tax purposes, and while not reflecting the ownership of the financial statement, a lease that is structured to provide a company with the tax benefits of ownership while not requiring the asset to be reflected on a company's financial statement is known as the synthetic lease. Finance or capital lease versus operating lease. There are two main classifications of leases: financial lease or capital lease, and operating lease. The economic substance of finance or capital leases is very different from operating lease, as are the implications of each of the financial statements for the lessee and leaser. In substance, finance or capital lease is equivalent to the purchase of some asset by the buyer that is directly financed by the seller, and operating lease is an agreement allowing the lessee to use some assets for a period of time, as if it was rental. Under the existing IFRS standard, the classification of a finance lease or an operating lease depends on a transfer of risk and reward incidental to ownership of the leased asset. If substantially all the risk and reward are transferred to lessee, the lease is classified as a finance lease. The lessee reports a lead asset and lease obligation on the balance sheet. Otherwise, the lessee is reported as an operating lease, in which case the lessee reports either an asset nor a liability, only the lease expense. Similarly, if the leaser transfers substantially all the risk and reward incidental to legal ownership, the lease is reported as a finance lease, and the leaser reports a lease receivable on the balance sheet and removes the lease from its balance sheet. Otherwise, the lease is reported as an operating lease, and the leaser keeps the leased asset on the balance sheet. Example situations that would normally lead to lease being classified as a finance lease includes the following. As mentioned previously, IFRS standards for accounting for a lease are applicable for financial years starting January 2019. IFRS 16 defines a lease as a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. Under IFRS 16, if a contract meets the above criteria, the lessee is required to reorganize all of its leases on the balance sheet. This involves recognizing both the right to use asset as a lease liability and the lease's balance sheet. In essence, IFRS 16 requires lessees to record both finance and operating leases in an identical manner. That is, an asset and associated liabilities in the assets in the lessee's balance sheet. Although accounting for leases under USG AAP is guided by a similar principle of transfer of benefit and risk, USG AAP is more perspective of a criteria for classifying capital and operating leases. Under USG AAP, leases can be recognized as either a capital, a finance, or an operating lease. For criteria are specified to identify When a lease is a capital lease, ownership of the leased asset transferred to the leasee at the end of the lease. The lease contains an option for the leasee to purchase the lease asset cheaply, or bargain purchase option, or the lease terms is 75% or more of its useful life of the lease asset. The present value of the lease payment is 90% or more of fair value of the leased asset. Because a financial lease is economically similar to borrowing money and buying an asset, a company that enters into a financial lease as a lessee reports an asset and related debt on its balance sheets. The initial value of both the leased asset and lease payable is the lower of the present value of the future lease payment and the fair value of the leased asset. In many cases, there will be equal. On the income statement, the company reports interest expense on the debt, and if the asset acquired is depreciable, the company reports depreciation expense. Note the following introduction of IFRS 16. All contracts meeting the criteria of a lease are classified as financial leases by the lessee, and the leaser continues to classify leases as either financial or operating. Because an operating lease is economically similar to renting an asset, a company that enters into an operating lease as the lessee records the lease expense on its income statement during the period and uses the asset. No asset or liability is recorded on this balance sheet. This has led leases to often prefer operating leases to financial leases. One lessee's statement of cash flow for operating lease and lease payments is shown in operating cash flow. For a financial lease, only a portion of the lease payment relating to interest expense potentially reduces operating cash flow. The portion of the lease payments that reduces the lease liability appears as a cash outflow in the financing section. Example 10 illustrates the accounting of a finance lease by a lessee. A company reporting a lease as an operating lease will typically show higher profits in early years, higher returns measured in early years, and stronger solvency position than an identical company reporting an identical lease as a finance lease. However, a company reporting a lease as a finance lease will show higher operating cash flow because the portion of its lease payments that reduces the carrying amount of the lease liability will be reflected as a financing cash outflow rather than an operating cash outflow. The interest expense portion of the lease payments on the statements of cash flows can be treated as operating or financing cash outflows under IFRS and is treated as an operating cash outflow under US GAAP. However, the effect of reporting under either an operating lease or financial lease over the life of a lease is neutral with respect to pre-tax profit. The explicit standards in the United States that determines when a company should report a capital lease versus an operating lease makes it easier for a company to structure a lease so that it is reported as an operating lease. The company structures the lease so that none of its four capital leases identifying criteria is met. Similar to debt disclosures, however, lease disclosures show payments under both capital and operating leases for the next 5 years and afterwards. These disclosures can help to estimate the extent of a company's off-balance sheet lease financing through operating leases. Example 11 illustrates the disclosures of operating and finance leases. Although these disclosures can be used to determine the effects on financial statements, if all operating leases are capitalized, the reading focuses solely on the information that is disclosed. Example 12 contains information about the Royal Dutch Shell of 2008 financial statement as required by IFRS. The balance sheet presents finance lease obligations in the line item labeled debt. Additionally, IFRS requires certain disclosures to be made in the note. The layout of disclosure notes on debt varies across companies. For Royal Dutch, the disclosure note on debt, note 18A, first shown a breakdown of total debt reported on the balance sheet into two components: the amount of debt excluding finance lease obligations and the amount of finance lease obligations. Note 18B provides disclosures on a component of on-balance sheet debt, excluding finance lease obligations. Next, Note 18C presents information about all the company's lease obligations, both finance lease and operating lease. Disclosure clearly illustrates that although finance leases and operating leases are both contracted obligations, only the finance lease are reported on the balance sheet. As mentioned above, a subsequent reading demonstrates how analysts adjust to total amount of debt as reported on balance sheets to also include the off-balance sheet obligations for operating leases. As mentioned previously, analysts should also be aware that IFRS 16 requires lessees to account for leases of more than 1 year in a similar way to finance leases. Accounting and reporting by the leaser. Similar to accounting and reporting by the lessee side, the leaser also must determine whether a lease is classified as operating or financial under IFRS. The determination of finance lease on the leaser side mirrors that of the lessee. That is the financial lease. That is in the financial lease. The leaser transfers substantially all the risk and reward incidental to legal ownership. Under US GAAP, the leaser determines whether an lease is a capital or operating lease using the same for identification criteria as the lessee plus the additional revenue recognition criteria. That is, the lessor must be reasonably assured of cash collection and has performed substantially under the lease. From the leaser's perspective, US GAAP distinguishes both types of capital leases. There are two main types of capital leases from a leaser's perspective: direct financing leases or sales type leases under IFRS US GAAP. If a leasers enter into operating lease, the leaser records any lease revenues. When earned, the leaser also continues to report the leased asset on the balance sheet and the assets associated depreciation expense on the income statement. Under IFRS, if a leaser enters into a finance lease, the leaser reports a receivable at an amount equal to the net investment in the lease. The leased asset is derecognized. Assets are reduced by the carrying amount by the leased asset. Initial direct costs incurred by the leaser, other than a manufacturer or dealer leaser, and added to the receivables and reduce the amount of income recognized over the lease terms. The lease payments is treated as payments of principal and finance income. The recognition of finance income should reflect a constant periodic rate of return on a leaser's net investment in the lease. Under the new IFRS and lease accounting, the lessor continues to recognize leases as either finance or operating lease in a similar manner as IAS 17. For leasers that are manufacturers or dealers, the initial direct costs are treated as expense. When a selling profit is recognized, typically selling profit is recognized at the beginning of the lease term. Sales revenue equals the lower of fair values of the asset or the present value of the minimum level payment. The cost of sale is the carrying amount of the leased asset, less the present value of the estimated guaranteed residual value. Under US GAAP, a direct financing lease results when the present value of lease payment equals the carrying value of the leased asset. Because there is no profit on the asset itself, the leaser is essentially providing financing to the lessee, and the revenues earned by the leaser and financing in nature. If, however, the present value of the lease payment exceeds the carrying amount of the leased asset, the lease is treated as a sales type lease. Both types of capital leases have similar effects on a balance sheet. The leaser reports a lease receivable based on the present value of the future lease payments and derecognizes the leased asset. The carrying value of the leased asset received relative to the present value of the lease payment distinguishes a direct financing lease to a sales type lease. A direct financing lease is reported when a present value of lease payments is equal to the value of the leased asset to the leaser. when the present value of lease payments is greater than the value of the leased asset. The lease is a sales type lease. The income statement effect will thus differ based on the type of lease. In a direct financing lease, the leaser exchanges a lease receivable for the leased asset, no longer reporting the leased asset on its books. The leaser's revenue is derived from interest on the lease receivables. In the sales type lease, the leaser's sales and assets to the leasee also provides financing on the sale. Therefore, in a sales type lease, a leaser reports revenue from the sale cost of goods sold, profit on the sale, and interest revenue earned from financing the sale. The leaser will show a profit from a transaction in the year's interception and interest revenue over the life of its lease. When a leaser enters into a sales type lease, it will show a profit from the transaction in the year of the lease inception and interest revenue over the life of the lease. Part 4, Introductions to Pension and Other Post-Employment Benefits. Pensions and other post-employment benefits give rise to non-current liabilities reported by many companies. Companies may offer various types of benefits to their employees following retirement, such as pension plans, healthcare plans, medical insurance, and life insurance. Pension plans often are the most significant post-employment benefit provided to retired employees. The accounting and reporting of pension plans depends on type of pension plan offered. Two common types of pension plans are defined contribution pension plans and defined benefit pension plans. Under a defined contribution plan, a company contributes an agreed amount or defined amount into the plan. The agreed upon amount is the pension expense. The amount of the company contributes to the plan is treated as an operating cash outflow. The only impact on assets and liabilities is the decrease in cash. Although if some proportion or portion of an agreed upon amount has not been paid by fiscal year end, a liability will be recognized on the balance sheet. Because the amount of the contribution is defined as the company has no further obligations once the contributions have been met. Accounting for a defined contribution plan is fairly straightforward. Accounting for a defined benefit plan is more complicated. Under a defined benefit plan, a company makes promises of future benefit to be paid to the employees during retirement. For example, a company could promise an employee annual pension payments equal to 70% of his final salary at retirement or until death. Estimating the eventual amount of the obligation arising from the promise requires the company to make any assumptions such as the employee's expected salary at retirement and the number of years the employee is expected to live beyond retirement. The company estimates the future amount to be paid and discloses the future estimated amounts to the present value. To determine the pension obligation, the discount rate used to determine the pension obligation significantly affects the amount of the pension obligation. The pension obligation is allocated over the employee's employment as part of the pension expense. Most defined benefit pension plans are funded through a separate legal entity, typically a pension trust fund. A company makes payments into a pension fund, and retirees are paid from the fund. The payments that a company makes into the funds are invested until they are needed to pay the retirees. If the fair value of the fund's assets is higher than the present value of the estimated person's obligations, the plan has a surplus, and the company's balance sheet will reflect a net pension asset. Conversely, if the present value of the estimated pension obligation exceeds the fund's asset, the plan has a deficit, and the company's balance sheet will reflect the net pension liability. Thus, a company reports neither a net pension asset nor a net pension liability. Each period, the changes in a net pension asset or liability is recognized either in profit or loss or in other comprehensive incomes. Under IFRS, the change in a net pension asset or liability each period is viewed as having three general components. Two of the components of this change are recognized as pension expense and profit and loss. Employees' service costs and the net interest expense or income accrued. Remeasurements include actual gains and losses and the actual returns on plans assets. Assets less any returns include in the net interest expense or income. Actual gains and losses can occur with changes that are made to the assumption on which a company bases its estimated pension obligations. The actual returns on plans asset will likely differ from the amount included in the net interest expense or income, which is calculated during rates reflected of a high quantity of corporate bond yields. Plan assets are typically allocated across various asset classes, including equity as well as bonds. Under US GAAP, the changes in the net pension asset or liability each period is viewed as having 5 components, some of which are recognized in the profit and loss in a period incurred, and some of which are recognized in the comprehensive income and amortized into profit and loss over time. The 3 components recognized in profit and loss in the period incurred are employees' service costs for periods 2, interest expense occurred on the beginning pension obligation, and 3, expected return on planned assets, which reduces the amount of expense recognition. The other 2 components are past service costs and actual gains and losses. Past service costs are recognition in other comprehensive income in the period in which they arise, and then subsequently amortized into pension expenses over the future service period of the employees covered by the plan. Actual gains and losses are also recognized in other comprehensive income in the period in which they occur, and then amortized into pension expense over time. In effect, US GAAP allows companies to smooth the effects of pension expenses over the time for these latter 2 components. Similar to the forms of employee compensation of a manufacturing company, the pension expense related to production employees is added to inventory and expensed through cost of sales. For employees not involved directly in the production process, the pension expense is included with salaries and other administrative expenses. Therefore, pension expense is not directly reported on an income statement. Rather, excessive disclosures are included in the notes and financial statements. Example 15, experts of pension-related disclosures of Novo Nordisk's 2010's annual report. Evaluating solvency, leverage, and convergence ratios. Solvency refers to a company's ability to meet long-term debt obligations, including both principal and interest payments. In evaluating a company's solvency ratio analysis, can provide information about the relative amount of debt, the company's capital structure, and the adequacy of earnings and cash flow to cover interest expense and other fixed charges as they come due. Ratios are useful to evaluate a company's performance over time compared to the performance of other companies and industry norms. Ratios analysis has an advantage of allowing the comparison of companies regardless of the size of reporting currency. The 2 primary types of solvency ratios are leverage ratios and coverage ratios. Leverage ratios focus on the balance sheet and measures the extent to which the company uses liabilities rather than equity to finance its assets. Coverage ratios focus on the income statement and cash flows and measures the ability of a company to cover the debt-related payments. Exhibit 3 provides the 2 types of commonly used solvency ratios. The first 3 leverage ratios used total debt in the numerator. The debt-to-asset ratio expresses the percentage of total assets financed with debt. Generally, the higher the ratio, the higher the financial risk, and thus the weaker the solvency. The debt-to-capital ratio measures the percentage of a company's total capital, debt plus equity financed through debt. The debt-to-equity ratio measures the amount of debt financing relative to equity financing. The debt-to-equity ratio of 1 to 0 indicates the equal amount of debt and equity, which is the same as the debt-to-capital ratio of 50%. Interpretations of these ratios are similar. How higher debt-to-capital and debt-to-equity ratios imply weaker solvency. A caveat must be made when comparing debt ratios to companies in different countries. Within certain currencies, companies historically have obtained more capital and debt than equity financing, so debt ratios tend to be higher for companies in these countries. The financial leverage ratio, also known as the leverage ratio or the equity multiplier, measures the amount of total assets of total assets supported by one money unit of equity. For example, a value of 4 for the ratio means that for each €1, the equity is supported by €4 of total assets. The higher the financial leverage ratio, the more leveraged the company is the company in the sense of using debt and other liabilities to finance assets. The ratio often is defined in terms of average total assets and average total equity and plays an important role in the DuPont decomposition of returns on equity. The interest coverage ratio measures the number of times a company's EBIT could cover the interest payments. A higher interest ratio indicates stronger solvency, offering greater assurance that a company can service its debt from operating earnings. The fixed charge coverage ratio relates fixed financing charges or obligations to the cash flow generated by the company. It measures the number of times a company's earnings before interest, taxes, and leases can cover the expenses, the company's interest and lease payments. Example 16 demonstrates the use of solvency ratios in evaluating a creditworthiness of a company. Summary. Non-current liabilities arise from different sources of financing and different types of creditors. Bonds are a common source of financing from debt markets. Bonds are initially valued at fair value when issued. And then companies have the choice of whether the subsequently measured bonds at fair value or amortized cost. Leases are related to the use of specific assets. In a financial lease, the lease assumes substantially all the risk and the benefit of ownership of the lease of the assets are related obligations. Typically, the leaser will report a lease receivable and derecognizes the asset. In an operating lease, the lessee secures the right to use the leased asset, but substantially all the risk and reward of ownership are not transferred. The leaser does not derecognize the asset and report a lease or rent income. Under IFRS 16, leases are more than 1 year are treated as in a manner similar to finance leases. That is, the asset is and the allocated liabilities is leases in the balance sheet. Pensions and other post-employment benefits are additional forms of compensation. Employees work currently to earn current salaries and wages, and also to earn benefits for retirement and post-employment. Companies with defined contributions plans report the agreed upon contributions paid into the plan as an expense. Defined benefit plans provides for agreed upon future benefits. Understanding the reporting of non-current liabilities when they arise and how they are subsequently valued is important in assessing a company's solvency and potential changes in its solvency. Key points in accounting and reporting of non-current liabilities includes the following. The sales proceeds of a bond issues are determined by discounting future cash payments using the market rate of interest and the timing of issuance. The reported interest expense of bonds is based on the effective interest rate. Future cash payments on bonds usually include periodic interest payments and principal amounts at maturity. When the market rate of interest equals the coupon rate of the bonds, the bond will sell at a par, i.e. the price is equal to the face value, which is what sell at a par means. When the market rate of interest is higher than the bond's coupon rate, the bond will sell at a discount. When the market rate of interest is lower than the bond's coupon rate, the bond will sell at a premium. An issuer amortizes any insurance discount or premium or bonds over the life of a bond. If a company redeems bonds before maturity, it reports a gain or loss in debt extinguishment computed as a net carrying amount of the bond, including bond issuance costs under IFRS, less the amount required to redeem the bond. Debt covenants imposes restrictions on borrowers, such as limitations on future borrowing or requirements to maintain a minimal debt-to-equity ratio. Coupons are required to disclose the fair value of financial liabilities, including debt. Although permitted to do so, few companies do opt to report debt as a fair value on the balance sheet. Accounting standards have traditionally required leases to be classified as either operating lease or financial capital lease. Leases are classified as financial lease when substantially all the risk and reward of legal ownership are transferred to the lessee. When a lessee reports a lease as an operating lease rather than a financial lease, the lessee usually reports higher profits before tax in the early years and the lease and lower profits in later years. However, the impact on pre-tax profits will be neutral between the choice of the leases. When a lease reports a lessee as a finance lease rather than an operating lease, the lessor usually appears more profitable in the early years of the lease. If a finance lease where the present value of the lease payments equals the carrying amount of the leased assets, a leaser earns only interest revenue. In a finance lease where the present value of lease payments exceeds the carrying amount of the leased asset, the leaser earns both interest revenue and profit or loss on the sales of the leased asset. Two types of pension plans are defined contribution plans and defined benefit plans. In the defined contribution plans, the amount of contribution into the plan is specified, and the amount of pension that is ultimately paid by the plan depends on the performance of the plan's assets. In a defined benefit plan, the amount of pension that is ultimately paid by the plan is defined, usually according to the benefit formula. Under a defined contribution plan, the cash payment made into a plan is recognized as pension expense. Under both IFRS and US GAAP, companies must report the differences between the defined benefit pension obligation and the pension's asset as an asset or liability on the balance sheet. Under IFRS, the changes in the defined benefit plan net asset or liability is recognized as a cost of the period with two components of change, service cost and net interest expense or income recognized in profit and loss, and one component of remeasurement of the change in recognized in other comprehensive income under US GAAP. The change in the defined benefit plan net asset or liability is also recognized as a cost of the period when three components of the change, current service cost, interest expense, and beginning pension obligations or unexpected returns are plan assets. Recognized in profit and loss, the components past service costs and actual gains and losses recognized in other comprehensive income. Solvency refers to a company's ability to meet its long-term debt obligations. In evaluating solvency, leverage ratios focus on balance sheets and measures the amount of debt financing relative to equity financing. In evaluating solvency, coverage ratios focus on an income statement and cash flows and measures the ability of a company to cover its interest payments. Okay, so here is reading 30. So we are halfway done with the CFA Level 1 program curriculum. CFA Level 1 has a total of 60 readings, and we are halfway done. So we will continue with study session 4 in our next reading about financial reporting and analysis in our next reading, which looks interesting because for CFA, they say financial reporting and analysis. Well, this is literally just accounting. Like, if you have taken accounting courses before, you would know that financial reporting analysis is literally the same as accounting. I did not talk about what I was drinking today. For 1 whole hour of reading, I did not drink anything. I have this 水果茶, 冰镇水果茶. It's a sweetened apple tea that I bought from 7-Eleven. It's kind of really sweet. This bottle has 267.5 milliliters, and it has 214 calories for this little bottle. Okay. I'm just trying. Yeah. I'm fluent in Chinese. 我讲中文是完全没有问题的。我在讲中文是很顺畅的。我其实也可以用中文讲话，我可以用中文上课，我其实完全都可以了解。yo también sé español. So yeah. Anyways, so just something interesting about me. So I do hope my readings have been helpful, and I hope to see you guys in your next reading. And goodbye. Bye bye.